Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending June 21st, 2024. I'm Preston Brent, and thanks for tuning in. Well, this week's theme is to FOMO or not, and that's going to be a real key area here as markets continue to climb very strong on the backs of AI. Why don't I just jump into where we were this past week, and then we'll take a look at the charts and where the markets seem like they want to go. Well, as you can see, the markets, most were in the green for the week, recording modest gains, a shortened holiday trading week here in the U.S., but it helped push the S&P to fresh all-time highs, the 31st all-time high for the S&P. We also saw this week a little bit of a broadening out in rotation in the market, just a little bit as value stocks started to outperform growth shares. Most of the major benchmarks outperformed also Nasdaq. And then this past Friday, we had what's known as triple witching, where roughly U.S. Dollars, we had about 5.5 trillion in options-related indexes, individual stocks, and exchange-traded funds expired and or rolled over to the following month. So always a very busy week. And generally in a triple witching week, the following week, next week, you got about a 68% of a slight pullback in the markets, just because of the rolling effect. And just hang on one second, guys. I got to move a few things around on my screen here and adjust a couple things. Hang on one second. Sorry, guys, I'm back with you again. So anyway, you can see on the screen here, everybody was in the green. Dow had the best week. The worst, Nasdaq, just barely in the green for the week. Almost flat, actually. Russell's still red year to date, okay? We did see this past Tuesday, we saw retail sales, they increased very small, less than expectations. And we revised down the prior month's retail sales. But we did see industrial production expand about 90 basis points in May. That was well above consensus, okay? Factories are also operating at about a 78.7% of capacity. That's a little bit above expectations. It's the highest level since last November. And then towards the end of the week, we got data that suggested the economy is still relatively strong in the retail sales arena. We got S&P Global announced their composite index, which combines both manufacturing and retail consumer. And it showed that business activity expanded 54.6 in June. All right, that's the best reading we've had on this S&P Global in over 2 years. Okay, so all in all, the market's still suggesting strength. The retail sales numbers pushed Treasury yields lower initially, but then that stronger S&P Global moved them back up. So moved up just a little bit for the week. The markets, though, are still a little bit bifurcated between believing there's going to be at least 2 rate cuts this year, while the Feds are still sticking to the story of just 1 rate cut for the year. So we'll see how that battle plays itself out. Meanwhile, debt in the U.S. is through the roof. We're at about 26.2 trillion in debt. The deficit alone is almost 2 trillion, slightly under. So that's a lot of funding that the U.S. is due in the auction market, and that's going to have to be fixed. Otherwise, it's going to really slow down the growth of the U.S. over the coming years, and it's also going to put a floor on interest rates, because every time we go to the auction market, we gotta borrow more and more. And since the Feds are cutting back what they're buying and rolling over U.S. debt because they got to get the balance sheet down, it's going to make it harder to keep rates lower with that high deficit in place there. So just a tremendous amount of spending. And I'll remind you guys that in the late 90s, the U.S. had a surplus. There was no deficit. And from the late 90s to where we are now, we're up to 2 trillion. Now, granted, we had the dot-com bubble, we had '08 and '09, and then we had COVID, but there's just too much money that's being spent at the US dollar printing press. So that's going to really damage and muck up everything in the coming decade, I believe. Okay. But you could see the PE ratio of the markets. The trailing 12 month is at 24, very high. The forward 22.27, still very high. I think the markets are very rich right now. 10-year Treasury finished the week at 4.25, dividend yield at 1.34. And the VIX, it was up just a little bit for the week, closing in at 13.2. So whenever you have the VIX moving up along with the equity markets, the VIX tends to win, meaning we can expect a little bit of a flattening to pull back in the U.S. markets this coming week. At least that's the way I would see it. The higher probability move. You could see the best performer for the week was discretionary, worst was utilities, and then annually, the best performer for the year so far is technology, up a whopping 18.86%. Real estate still bringing up the rear with interest rates staying higher for longer. Okay. Then, of course, if we come over and we look at the European markets, just to kind of see how they're playing themselves out there. You can see over in Europe, everybody was in the green, from the Euro stocks to the DAX. Remember, the prior week, everybody was in the red because of France and Macron calling a snap election the end of this month. It can still roll back over. You can see the CAC 40 was up 1.67 for the week and up 1.13 year to date. They gave up over 6% year to date gains all in 1 week with the problems over in France. FTSE, Euro stocks, all of them up, DAX up. Year to date, everybody's in the green. We got, as expected, the Bank of England, they left their key interest rates unchanged. They're at a 16-year high of 5.25. Meanwhile, they dropped their headline inflation over there to 2.3%. Their core inflation, they eased it down to 3.5 from 3.9 in April. Services inflation, however, was 5.7. So it's still fairly high. Meanwhile, if we go across to the Eurozone and take a look at them, that combines, that composite PMI, it seems to be a favorite, combining both services and manufacturing. It fell to 50.8 from 52.2 of the prior month. So 50.8 is just slightly in expansion territory, but not by much, right? So Europe is still having issues. Now, if we go over to the Asian market, see the Nikkei was in the red, 50 basis points. The yen weakened to the US dollar again from the prior week. It's around 34-year lows. I love the yen to the upside long term, right? I think the bigger move is upside move. It is not downside move. And then on the economic front, over there in Japan, we did see some expansion in business activity across their private sector, but it stalled a little bit. The flash PMI fell to 50, so it's like right on that borderline between expansion and contraction. The prior month was at 52.6, so it pulled back. But we did see Japan's exports surging over 13.5%. That's mostly because of the weak yen. It makes it a lot cheaper to send that stuff over to Europe, export goods and products and so forth to Europe and the U.S. Okay, and then of course if we go over the Chinese markets, you can see China was in the red for the week, barely in the green year to date. Hang Seng, the Hong Kong index, in the green both weekly and year to date. China, we did see industrial production. It rose, but at a weaker than expected 5.6%. Okay, it slowed from over 6.7% the prior week. And even though fixed asset investments grew in the calendar year, 4%, they're having a lot of trouble. Still, with unemployment at 5%, new home sales fell 70 basis points in May, all right? And that was one of the steepest month-over-month contractions in nearly a decade in their real estate market. And China, just like Japan, is still putting money into their markets, all right? They're still pumping money in. So it's one of the few countries that are putting money into the markets. And so you just have to watch this very carefully here, especially China with their real estate problems. Now, what I'm going to do is switch you over and just give you a quick rundown of what I'm seeing in some of the charts here. And let me just take us over first to the E-mini S&P 500 futures. And we'll take a look at those first. And as you can see when it comes up on the screen, we hit a high on June 20th, all-time intraday high, up 16.12%. Year to date now it's up 14.57, but that's an intraday high. Right now with that pullback, we're down 14.57 for the S&P. It's still fairly robust. You can see I have some pullback points on the screen. This was my original target, which we hit. As you guys know, or you've been following me, generally this is a very solid target point, and when we blow through it, we usually come back and test it. So that would bring us back to around 5,400. I've got a pullback zone that's fairly wide, but if we were to split it in half, it'd be anywhere from 53.83 down to 52.67 as we go through the first half of July. So I think a little bit of a pullback's in order, although if you look at the MACD, there is no bearish divergence. That does suggest any pullback, for all practical intent purposes, will be bought. Here's the 50 EMA sitting right around 5,300, roughly 5,308 actually, but let's call it 5,300. So a little bit of a pullback I think we can expect. I'd be surprised to see too much more upside without a little bit of a softening in price. And if we look at Nasdaq, you're going to see here, same thing, a little bit of a pullback here in Nasdaq. There is no divergence in the MACD, so you can see how far away it is from the 50 EMA, which is sitting right around 18.8. So I think a pullback half the distance to me makes sense, right, between 15 or 18.8 and the current closing a little over 20,000. So about 1,000-point pullback in Nasdaq over the next couple of weeks makes sense for me before more buyers come in. Okay, and then of course, if we look at the Dow was the only. It had the strongest week. It was up 1.45% for the week. You can see here. Generally, when we get weakness in Nasdaq, we get strength in the Dow, which is kind of interesting. You can see the closing price of last year provided strong support. We finally moved above the 50 EMA. We're at a little bit of a resistance point here, but the Dow is still only up year to date. It's only up 3.88%. So it's trailing a good deal. And then, of course, if we look at the Russell, it's the only index right now in the US that's in the red. It could be a little early warning sign. You can see here that we're slightly below where it closed last year. 37 basis points in the red, okay? Just slightly below the 50 EMA. And when you have small cap, this is one of the widest divergences I've seen in decades with the small cap and Nasdaq and the S&P. So that could be an early warning sign that we're due for a little bit of a pullback, which again, it would not surprise me at all. And of course, if we come down here and we look at the VIX right here, you can see the VIX closed out the week at 13.20. Okay. And it's actually been moving up since the 13th of June. Slowly been moving higher. I think it's going to break 14 again this week and come up and test this little point right back over here that we last saw in May, right around the 15 level, almost 15. I think we could see that over the next week or so as we move through the July 4th holiday weekend here, a holiday week here in the US, going into the middle of July. Okay. And then, of course, if we come down here and look at treasuries and we look at the bond market, it was relatively flat on Friday, but you can see it's off these lows. So that just means interest rates are coming back down again. Okay. And we hit a low here towards the end of April. And the bonds were actually down 9.31%, but now we're moving back up. We've cleared the 50 and the 200 EMA. This is the bet the markets are making. The markets are making a bet that there's not going to be one but two rate cuts this year, September and December. The Feds are saying possibly one. So one's going to be right and one's going to be wrong, all right? And that's going to affect valuations all across the markets, all right? So, and we're going to, as we get more data, it's going to be real important to pay very close attention to it to see how it shakes out, okay? And if we come over here and look at currencies, if we look at the dollar, because of the difference between the interest rates in the US and everywhere else, The U.S. hadn't cut rates yet, but we're starting to see cuts across the board in many other countries. Of course, Bank of England, as I said, did not cut their rates. They left it unchanged at 5.25 this past week. But you can see the dollar staying relatively strong against the euro. Remember, the euro is 58% of the dollar index. It's really the dollar index. And if we look at the euro, it's down. You can see it's coming back down, challenging its lows for the year, right? And it just made lows in April, right? Just less than a month, about a month, a little over a month ago, 5 weeks ago, it was down. So the euro is near term, can go a little bit lower. The dollar's going to go a little bit higher, but there's going to be a time when the euro is going to be a good play. And then, of course, the yen, it's very low, 34-year low right here. But in fact, this low here on Friday was the lowest closing low, because notice here, these weren't closing lows. It's even, to me, a great trade to the upside. It really is. I like that trade to the upside, the yen. Okay, and if you want to play it, you can play the futures market, the currency market, or an easier way to play it is just with the ETF, FXY, right? You can see this low here. It's got bullish divergence all in it, so going long FXY to me makes sense. Okay, and then of course if we come down here and look at gold, I told you guys gold is, if it breaks the 50, it's going to come down. So it's going to test the 50. I believe it's going to break it. I'm not going to touch gold. I think it's going to go lower in the next 4 to 6 weeks. It's probably going to test this gap right here between the 2250 and 2234 area. I think it's going to hold a little bit and then come down and test the 200 EMA. So I would not play gold long right now at this time. Same thing with silver. You know, one leads and the other comes behind it, and then sometimes they just bounce around a little bit. But you can see silver, that looks like a bearish engulfing pattern, hitting my target there. This was my original target. I think it's going to come down and test the 50 EMA and break it and come down a little bit lower and test this low that was made back in early May. Okay, so that's a little bit about where I see the precious metals market. Oil, well, I think this big move higher in oil is going to run out of steam. We're going to pull back and test the 50 EMA, 50 and 200 EMA. Okay. Once that happens, I think we'll get a final push higher and then it'll move lower. But for those that are in our group, our user group, that understand how to trade oil, especially using our techniques, you should be in profits, should be doing well in this thing, right? And if it keeps going higher, it's a no-lose trade for you. And then, of course, if we look at nat gas had that big run. Now it's pulling back as I said it would. It'll probably pull back to around the closing price of last year, the 50 or the 200, and then we'll make another run higher. Back over here was when I was urging all of my our members and you actually in the free roundup to be going long nat gas right here. It's a very good trade to take. Okay. All right, everybody, that's a little bit about where we're sitting right now and some of the major stock charts, and a little bit here, as I said, not this coming week, but the next week, we got a big holiday in the U.S. markets. The markets will close, as a reminder, July the 3rd at 1 p.m. Eastern time and be closed all day on July the 4th. So a little bit of a break in the middle of the week for everybody. Otherwise, members, I'll see you Sunday evening for our weekly market watch. And if you're not a member, I highly encourage you to come in and see us. Take care, everybody.